The collapse of the short-term rental market in 2025 has triggered a chain reaction across commercial real estate, especially in cities and regions once dependent on a steady flow of Airbnb guests. As the market for short-term rentals unraveled, an estimated $4.2 billion worth of former Airbnb properties hit the market within months. This sudden surge in available inventory has created a pronounced oversupply, especially in tourist-driven areas, and sent property values into a downward spiral. Nowhere is this more evident than in Miami's condo sector. After years of rapid appreciation driven by investors banking on short-term rental profits, the market reversed course abruptly. When 1,200 former Airbnb units were listed for sale or long-term lease in a single quarter, condo prices dropped 18%, the sharpest quarterly decline since the 2008 financial crisis. Many of these units had been purchased at the height of the pandemic boom, when remote workers and investors flooded the city. Owners who bought in 2020 or 2021 now face average resale losses of 23%, with rental income unable to cover mortgage payments at current rates. Mortgage defaults among professional hosts have surged as a result. In 2025, the default rate for these owners reached 6.7%, triple the national average for residential loans. The hardest-hit markets, Orlando, Las Vegas, Phoenix, are seeing a wave of foreclosures as hosts who once relied on high nightly rates can no longer make payments. Lenders with large portfolios of short-term rental loans are reporting delinquency rates as high as 15% to 20% in some regions. As more properties enter foreclosure, values for neighboring units drop further, and condo associations struggle to collect fees from investor-owned units. The glut of unsold or unrented properties is not confined to urban centers. Coastal vacation towns from Cape Cod to San Diego have seen their inventory of homes for sale double year over year. Unlike city condos, these properties often sit vacant between owners, unable to quickly convert to long-term rentals. The result is a patchwork of empty houses, fewer full-time residents, and weakened local economies. Seasonal businesses are hit especially hard as off-peak populations shrink, and local governments report a 19% drop in tourist tax revenue across former short-term rental hubs. The ripple effects extend to industries built around the short-term rental ecosystem. Cleaning companies, many of which relied almost exclusively on Airbnb turnovers, have seen revenues fall by 38% in top markets. Property management firms are downsizing as portfolios shrink, and developers have paused or canceled thousands of planned units intended for STR investors. Miami-Dade alone has 47 condo projects on hold, totaling over 11,000 units. Supply chains feel the impact too. Furniture and smart home device suppliers have reported sharp declines in orders, and insurance providers are canceling policies or increasing premiums for properties with any short-term rental history. Underlying these disruptions is the reality that many STR investors depended on appreciation rather than sustainable rental income. Nearly 40% of professional hosts used interest-only or adjustable-rate loans, betting on rising prices to stay ahead of mortgage resets. When the market turned, these strategies collapsed, and bulk sales to cash buyers and hedge funds became common, often at steep discounts. Secondary markets like Nashville and Charleston are now seeing rising inventories and slowing sales, with buyers hesitant to step in as prices continue to soften. Communities are left to navigate the fallout. Some neighborhoods have responded with new restrictions on converting properties back to short-term rentals, while others offer incentives for long-term leases to stabilize the market. The process of unwinding years of STR-driven investment has exposed how deeply these platforms reshaped local real estate, and the adjustment is proving both complex and painful for owners, lenders, and cities alike. As the financial strain intensifies, property owners and investors are looking for ways to reclaim lost margins and adapt to the new reality. The next pressure point is emerging not from falling property values, but from the growing frustration with the costs of simply using the platforms themselves. The platform fee revolt. Host frustration with platform fees has reached a boiling point in 2025, fueling what many now call the platform fee revolt. Airbnb's commission structure, taking up to 17% of every booking, has become a central complaint among operators. At current occupancy rates, these fees can consume nearly half a host's net income, an erosion of profitability that was unthinkable in the platform's early years. For many hosts, the math no longer works. After accounting for platform fees, rising cleaning costs, maintenance, and mortgage payments, the margins are too thin to justify the effort and risk. The response has been swift and widespread. Hosts are increasingly listing properties on multiple platforms, a strategy known as multi-homing. By spreading listings across Airbnb, VRBO, Booking.com, and emerging competitors, hosts hope to capture more bookings while minimizing the impact of any single platform's fees. Data from 2025 shows that nearly 40% of hosts now multi-home, up sharply from just a few years ago. This trend is especially pronounced among professional operators managing several properties, but even individual hosts are adopting the practice to protect their income. Direct booking websites are also gaining ground as a way for hosts to bypass platform fees altogether. About 12% of short-term rentals now operate primarily through direct bookings, with owners building their own websites and handling guest communications themselves. This approach eliminates intermediary fees, allowing hosts to set their own prices and retain a larger share of the revenue. In popular vacation markets, direct bookings have surged as repeat guests return year after year and hosts build up independent reputations. The shift requires more effort in marketing and guest management, but the financial upside is significant, especially for those with established properties and loyal clientele. The revolt is not limited to individual actions. Property management companies are reevaluating where they list premium inventory, prioritizing platforms with lower fees and better support. Some firms openly advertise their ability to maximize exposure while minimizing commissions, and they increasingly steer clients towards services that offer more transparent pricing. This professionalization of platform shopping is changing the composition of inventory on each site. Airbnb, once the default for top-tier properties, is losing ground to competitors who promise more favorable terms. Hosts consistently cite poor value for money as their main grievance. Airbnb's fees have increased, but many operators say customer support and platform tools have not kept pace. Response times for support requests have lengthened and promised product improvements, like better integration with smart locks or payment processors, remain unreliable. Hosts feel they are paying premium rates for basic services, while competitors offer similar or better functionality for less. The discontent is especially acute in regulated cities, where hosts must spend extra time and money to comply with local laws, only to see a significant portion of their earnings go to platform commissions. Booking.com and VRBO have capitalized on this discontent by highlighting their slightly lower fees, typically around 15%, and by providing clearer breakdowns of costs. Their marketing targets hosts directly, emphasizing transparency and the ability to retain more earnings per booking. This straightforward approach resonates with operators who are tired of opaque pricing structures and unexpected deductions. Alternative pricing models are also gaining traction. Some platforms now offer flat-rate subscription services, which can save high-volume hosts thousands of dollars annually compared to per-booking commissions. Others, like niche vacation rental agencies, negotiate custom fee arrangements or bundle management services with lower commissions. Even traditional real estate agencies are re-entering the market, offering short-term rental management at rates that undercut the major platforms. Many hosts are taking matters into their own hands by encouraging repeat guests to book directly, leaving contact information in properties or in follow-up messages. These practices, while technically against platform terms of service, are difficult to police and have become commonplace as hosts seek to reclaim control over their bookings and finances. The fee revolt is changing the competitive landscape. As more hosts leave or reduce their reliance on Airbnb, the platform's inventory skews toward larger professional operators who can absorb higher costs. This shift further distances Airbnb from its original promise of unique, locally managed stays and pushes guests to seek alternatives. Municipal policies requiring transparent fee disclosure and the rise of public listing portals add to the momentum, giving hosts more options and more bargaining power. Airbnb's fee structure, once a reasonable trade-off for access to a vast pool of travelers, now stands as a barrier for many operators. As the revolt spreads, the platform faces a choice: adapt to the changing expectations of hosts, or risk losing the very properties that made it successful. The financial realities are forcing hosts to reconsider not just how they list, but why, and whether the platform's value proposition still holds up under scrutiny. The experience economy myth. The so-called experience economy that once set Airbnb apart has lost its relevance in 2025. The company's original pitch, immersing travelers in authentic, local life, has faded, replaced by a reality where almost 9 out of 10 guests never interact with a host at all. Instead of sharing stories over breakfast or getting neighborhood recommendations, most guests receive nothing more than automated check-in instructions and a lockbox code. The days of warm welcomes and personal touches have given way to a streamlined, transactional process. For many, an Airbnb stay now feels much like booking a generic hotel room, only with more rules and less predictability. This shift isn't just anecdotal. Data shows that 76% of guests now choose listings based purely on price and amenities, not on any promise of cultural immersion. The priorities that once fueled Airbnb's growth, unique homes, local connections, and memorable experiences, have been overtaken by a demand for cost-effectiveness and convenience. Younger travelers, who once drove the platform's popularity, now lead the exodus. In 2025, 82% of travelers under 35 say they prefer hotels, citing reliability and standardized services as their main concerns. Their preferences reflect a broader generational skepticism. After years of inconsistent quality, surprise cancellations, and requests to complete chores before checkout, they're opting for predictability over the unknown. Despite these clear trends, Airbnb continues to pour the majority of its marketing budget, 63%, into experience-focused messaging. Commercials still depict guests forging friendships with hosts and discovering hidden gems, even as most users report no meaningful interaction during their stay. This disconnect between branding and reality grows more apparent each year. The images of home-cooked meals and local adventures are at odds with the experience of checking into a professionally managed property with generic decor and no personal touch. The persistence of this marketing narrative suggests a reluctance or inability to adapt to what the majority of guests now value. The rise of professional operators has accelerated the loss of Airbnb's original identity. In 2023, 28% of listings were run by hosts with 10 or more properties. By 2025, that number has climbed to 41%. These corporate hosts focus on efficiency, not experience, and their properties often look and feel interchangeable from city to city. Guests increasingly scroll through listings that feature the same staged photos and standardized amenities, with little indication of any local flavor or host involvement. The personal profiles and stories that once distinguished Airbnb have largely disappeared. Pricing and transparency issues have further undermined the platform's experiential appeal. Airbnb's attempt to address hidden fees with its all-in pricing policy backfired when hosts simply raised base rates. Now, the average nightly cost is on par with mid-range hotels, but without the consistency or service those hotels provide. Guests expect more when paying hotel-level prices, yet they often encounter missing amenities, malfunctioning appliances, or unexpected cleaning requirements. The frustration is compounded by the fact that 61% of guests still report undisclosed fees at check-in, eroding trust and making the value proposition even less compelling. Boutique hotels have stepped in where Airbnb faltered. Properties that emphasize local art, partnerships with neighborhood businesses, and knowledgeable staff now offer the kind of authentic experiences Airbnb once promised. These hotels combine curated local touches with professional reliability, making them attractive to travelers who are willing to pay for something unique, but expect it to be delivered consistently. As a result, the very market Airbnb helped create is now being served more effectively by competitors who have learned from its missteps. The gap between Airbnb's marketing and the real guest experience is increasingly difficult to ignore. While the company continues to highlight living like a local, most guests are focused on practical concerns, price, amenities, and transparency. The myth of the experience economy has become a liability, as travelers turn to options that better align with their actual needs. This shift is forcing not only platforms but also cities to rethink how housing and travel intersect, opening the door for new policies and approaches that address the realities of today's market. The urban planning revolution. Urban planners in 2025 are rethinking city strategies, using the decline of short-term rentals as a chance to address long-standing housing shortages. Toronto's Housing Recovery Act stands out as a leading example of this new approach. The city incentivizes property owners to convert vacant short-term rental units into affordable housing by offering targeted tax breaks. In just 3 months, this policy returned 6,300 homes to the long-term rental market. The impact has been immediate. Average rents in affected neighborhoods have dropped by 11%, providing relief in areas previously dominated by investor-owned STRs. The program focuses on buildings where more than 40% of the units were used for short-term rentals, and property owners receive tax incentives covering a portion of conversion costs if they commit to below-market rents for at least 5 years. Other cities are following suit with their own policy experiments. Amsterdam has implemented data sharing requirements for platforms like Airbnb, mandating real-time vacancy reporting. This allows city officials to monitor housing availability, enforce rental laws, and respond quickly to emerging shortages. In the first month of this system, Amsterdam identified 1,200 illegal listings and issued automated compliance alerts to property owners, giving them 2 weeks to address violations. These measures let the city base its interventions on actual usage data rather than estimates, making regulation more precise and effective. Paris and Barcelona have announced plans to adopt similar systems, aiming to close loopholes and prevent illegal rentals from slipping through the cracks. Los Angeles has adopted a two-pronged strategy: strict enforcement combined with financial incentives. The city's rental conversion program waives transfer taxes for landlords who remove units from the short-term rental pool permanently. Since the start of 2025, 800 buildings have transitioned to long-term housing, expanding the affordable inventory without building new units. LA has also increased fines for illegal short-term rentals and introduced an amnesty program for owners who voluntarily comply. This approach rewards those who transition their properties while penalizing persistent violators, helping to shift the balance back toward residential stability. Vienna has taken an even stronger stance by seizing properties from chronic STR violators and converting them to social housing. Using eminent domain laws, the city transferred ownership of 340 buildings to housing nonprofits, which then renovated and leased the units at below-market rates. Legal challenges have failed, as Austrian law prioritizes housing access in times of crisis. Vienna plans to expand this strategy, targeting neighborhoods with particularly low vacancy rates and significant housing stress. Smaller cities and tourist destinations face different challenges. Resort towns like Aspen and Park City have introduced tiered systems that allow limited short-term rentals during peak tourist seasons, provided owners live on-site and commit to long-term rentals during off-peak periods. These policies try to balance the needs of local economies with the demand for year-round housing. The effectiveness of these urban planning measures depends on robust enforcement and the use of technology. Toronto has developed algorithms that cross-reference property records, utility data, and listing information to flag likely violations. Inspectors then verify these leads, resulting in a high accuracy rate and reducing enforcement costs. Automated compliance tools have helped cities like San Francisco cut illegal listings by more than half within a year, showing that policy alone is not enough. Ongoing monitoring is essential. Financial markets are beginning to reflect these regulatory changes. Real estate investment trusts specializing in short-term rental properties have written down asset values, and lenders now require higher down payments and charge higher interest rates for mortgages on homes likely to be used as STRs. These changes make speculative investment less attractive, reducing the pressure on housing stock and discouraging the conversion of homes into commercial rentals. The rapid results in cities like Toronto demonstrate that coordinated policy action can make a measurable difference in housing availability and affordability. As these localized solutions prove effective, regional coalitions are starting to coordinate regulations to prevent hosts from shifting operations to neighboring jurisdictions with looser rules. Broader frameworks at the state and national level are under discussion, aiming to support city efforts and standardize best